And now back to one of our other top stories this morning. That is your markets. We are truly coming off a manic Monday. The Dow Industrials turned in a 245-point loss Monday after a 900-point swing intraday. The head-spinning swing showing how fragile the market is and how easily it can be rattled, particularly when it comes to technology. And of course, we've got Facebook reporting after the bell. Let's add that into all the fun. And let's bring in for some more fun Scott Sheldy of TJM Europe and Ian King of Banyan Hill. Hey guys, good morning.
Good morning.
Good morning.
Yeah, Scott, I want to start with you from the trader technical perspective here. You know what? The Nasdaq's in correction territory. The Dow and the S&P are flirting with correction territory right now. From a technical perspective, Scott, what does this say to you?
Well, that's what we do, is when we don't really have a great reason for the sell-off and nothing's new out there to push us lower like we have been as of late. We run to those technicals, right? We go into the closet, we get out that little map, and we get our flashlight out, and we look at the technicals. And the technicals are weak. It looks like we're going to try to make another push lower, but that's okay. We're moving stocks from those weak hands to the strong hands. And let's just say we take another 5% or so off that S&P. It's going to put us back to less September 2017's levels. So it's okay. We've got room to go down, and stocks are allowed to go down. For all of you that wanted to normalize interest rates, we also have to normalize volatility, and it used to be a lot more volatile. We've got a generation of traders that haven't seen it like this before.
That's true. Those young kids, this is what I'm sure they're enjoying this today. Ian, but he makes a couple of great points. First, about the Fed and interest rates. Now there's kind of question marks about what the Fed will do or not do in December. Maybe they'll hold off on an interest rate hike. But I want to talk about FANG really quick here, because those FANG stocks, if you look at them from their peaks of 2018, Ian, they've lost about $824 billion in market cap. Now you could say, look, that is money on paper and that stocks go up and down, but that has a lot of average investors, Ian, really nervous about their overall portfolios.
Sure. I think really what's going on here, though, is that the yield curve is still steep. So if you look at bank earnings, their net interest margins are still positive. Banks borrow in the short end of the curve. They lend in the long end of the curve. So in terms of the banks, I wouldn't be as concerned as more of the momentum and growth sectors of the market right now, such as technology.
So looking at other sectors, Scott, he makes a great point. Technology starts at the only stocks that we can actually trade, Scott. But also, there's been a lot of talk for that maybe Amazon and Apple, that those are just crowded trades right now, that there's just too much money into those stocks, and we need to kind of diversify a little bit. And that's a trader's perspective as well as an investor.
You're exactly right. And what I hear from the guys that I speak with and trade with every day is that, when we have this earth shake a little bit and everybody gets a little nervous and a few folks run for the doors, the things that get hit the most are the things with the highest multiples that are a little bit out of whack, right? So they're the ones like Amazon that are going to get trimmed back here to come back in line with, say, 15 with the other stocks in the S&P 500. So It's not crazy. It's okay. We just have to take a step back and say this is what happens when, stocks are allowed to go down. And I think that ultimately it's going to make your muscles stronger when you break them down and build them back up again. And the market can continue this long bull rally. I'm not nervous yet. We haven't seen capitulation either, so we can still go lower, but that's still going to be okay.
We haven't capitulated. That's a really great, point to bring out to the average person out there, is that you will know capitulation when you see it, and that means I'm out, I give up, I'm selling my book, it's over. But that's not happening. Really quick, Ian, last word to you. I want to switch gears really quick. We've got the midterms. We're now a week away from the midterms. A lot of analysts have been saying normally gridlock in Washington is good for the markets, but this year is different, Ian, and that many analysts are saying that if the Republicans lose the House to the Democrats next week, that's actually going to be a market negative. What do you think about that sentiment?
I don't necessarily agree with that. I think that gridlock is good for the markets. We already have cut the corporate tax rates down to 21%. I think if you see the Democrats sweep the House and the Senate, you'll see more of a bipartisan push for an infrastructure plan, which I think the market will really, really love. So I think that a Democratic wave actually would be a positive for the market, and I know this is kind of counterintuitive to what the narrative is right now.
Well, no, that was the narrative 2 years ago, and here we are now. Ian, Scott Sheldy, history upended again. Guys, thank you very much. Appreciate it.
All right, see ya.
Well, Google employees are mad.